Greetings, fellow investors. I'm Matthew Cochran, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Will Thomson, the founder and managing partner of Massif Capital. Will has a fascinating journey that took him from Afghanistan to Lloyd's of London before founding Massif Capital. Massif Capital Real Asset Strategy is a global long-short equity strategy built around bottom-up stock picking. They are focused on creating a portfolio of businesses from within the energy, basic materials, and industrial sectors that balance the environmental and economic realities of achieving a carbon-neutral economy. As regular listeners know, this is an area where I'm a little out of my depth, so I'm excited to learn more. And Will, welcome to the show.
Thanks for having me.
Of course. Will, why don't you just share with us briefly? I kind of alluded to it in our introduction, but just share with us your background and how you came to found Massif Capital and what you do there.
Yeah. So I think I guess there's sort of three formative events, if you will, almost in my life that brought me to this point. So I was lucky enough to have a family that worked in finance and had some strong relationships on Wall Street. So I got my first job on Wall Street at 16 as a summer intern working for Bank of America's healthcare equity research group. So I've spent basically my entire career in finance, almost, my entire formative life in finance in some way, shape, or form. But went to grad school, and at grad school I wrote a paper that looked at Afghanistan. I didn't go back and get an MBA. I had a choice. It was 2008, 2009. Everybody was going back to get MBAs. I made a decision to go off and do something else because it sort of seemed like if everyone's getting MBAs, I should do something else. Ended up in Afghanistan as a result of that paper that I wrote. And it was quite a fascinating experience because you go over to places like Afghanistan, and now we invest globally. I go to places, I go all over the place, all over Latin America, Africa, etc. So go to a lot of these sort of developing countries. And one of the things you see right away is just sort of look at the environment. And some environments clearly lend themselves to development, and other environments don't lend themselves to development very well. And Afghanistan is not an environment that lends itself to development. They've got resources, but monetizing them is very difficult. And I think equally important, there's a bit of a feedback loop between development and the environment where, our development has an impact on it. And sometimes that impact can be positive, sometimes it can be negative. Sometimes it's negative, but we have to accept the fact that it's negative because there's a greater good that's created. Afghanistan is one of those countries where it really crystallized to me that, some environments are favorable for development and growth, and some environments aren't. And we want to do the best we can to make sure that the environment we have sort of writ large is a good one for development. Came home from Afghanistan, worked at Lloyd's of London, actually starting up a New York office for a Lloyd's of London insurance syndicate, and focused on writing political and credit risk insurance policies, mostly for commodity traders, project finance for banks, things like that. So commodity trader Glencore would come to us and say, we want to buy $100 million worth of copper over 5 years. Will you write us an insurance policy if on any given year they don't deliver that copper to us? Sure, we'll write you an insurance policy. Challenge with that is that, of course, insurance, if everything goes right, you make the premium, but you don't get any additional upside. If it goes wrong, and in the case of political and credit risk insurance policies, the asymmetries are quite nasty, right? So that Glencore example I gave, $100 million worth of copper, 20 million a year, that policy, I don't know, would have been 2% per annum. So obviously, if it goes wrong, I've wiped out a lot.
Right.
A lot of my premium. So I loved the industries that we worked in: industrials, materials, energy. They were my focus in grad school when I studied political risk for natural resources development. In Afghanistan, I worked on natural resources laws in Afghanistan. So, businesses that I loved, but that asymmetry, that sort of negative asymmetry, if you will, and the inability to benefit from things working out, was a bit of a drag, especially given if you run a clean insurance book, that almost by definition means that everything worked out. And
Sure,
everything
right.
worked out, but I didn't get any additional benefit. So I started Massif Capital after going around and started talking with a lot of hedge funds in New York. And everyone was like, mining, meh, not interested. Energy, meh, every once in a while. Industrials, sure, all the time, but not our bread and butter. And everyone sort of said, these are interesting ideas, but we're tech and biotech and healthcare and stuff like that. And so there really was only a couple of firms that were, say, some long-only energy companies or long-only energy funds. There was a couple of long-only mining firms up in Canada. But nobody was really looking at what we've now come to call the real asset ecosystem, which is energy, materials, and industrials combined. They're a tightly interrelated group of businesses. Industrials tend to consume the immediate outputs of the other two, and they tend to produce a lot of products that are consumed by the other two. There's this tight interconnection, and when you throw in infrastructure, which is also a real asset we focus on, those businesses form the foundation of society. So whatever comes after, computers, TikToks, Twitters, etc., it all depends on this foundation. And so that's really what we focus on, the foundation.
So let me just pick at something you said that I thought was interesting. You said you were in Afghanistan and you had written a paper about it in college. And you said you determined Afghanistan was not an environment conducive to investing. Like what so when you look at like those kind of, I mean, I don't even know if you call them emerging markets, almost like these pioneer markets, right? Like just on the outer edge of like even the emerging economies, like what are you looking for? And like, so what about Afghanistan? If you can just like maybe boil it down to like a few like, principles, but like what are you saying like about Afghanistan? It's like, that's really not investable. And then what would you look for in a economy like that would be like, maybe that is investable?
Yeah. So one of the things we focus a lot on is this concept of sustainability. Now, usually when people talk about sustainability, they say, yes, we invest in sustainable companies, and then they move on. My opinion, every time someone says that, you should raise your hand and say, wait a second. When you say sustainable, what do you mean? Okay, because that's a big concept. It's a big term.
Sure.
And so from our perspective, it's two things. And if someone said to me it's 3 or 4 or 5 things, there are other ways of looking at this, but at a minimum, there are 2 variables here. One is the economics and one is the environment at a minimum. Okay, you could also throw in some other ones, but sustainable economics from a business perspective would be something like a business that is self-financed, right? So it doesn't have necessary recourse to capital markets to continue its operations. It can, look, maybe at time it needs to borrow money for a merger or an acquisition. Okay, that's different. But the business itself can run on the cash flow it produces.
It's just generating cash flow. It's generating profits. It can sustain itself.
Yeah. The other side is the environmental component of it. And from our perspective, how we evaluate it is whether we think a company can continue to operate in whatever likely environmental regulatory environment comes down the pipeline in the next 10 years. Basically, they can continue to do what they're doing without a significant impact from regulatory change. You could look at it in different ways. That's a very functional way for us to deploy the term. Okay, so when you go to a place like Afghanistan, or you go to any number of other emerging economies, one of the critical questions you're asking is, can one build a sustainable environmental and economic economy and society on this plot of land. In the case of Afghanistan, so what would sustainability start with? Well, sustainability would start with one of two things. It would start with either the ability to produce enough food that you can feed yourself, or the ability to produce some product on a continuous basis with enough margin in it such that you can import all your food. The second of those two is not quite as sustainable as the first, but in the case of Afghanistan, they don't really have either.
Okay.
So how do you even get an economy started when the best they can do is subsistence farming, and even that they struggle to feed themselves, and a function, but that is in some regards a direct function of the land, right? They don't have, it's not terribly great land to grow things in. Look, they've got some resources, and amusingly enough, the Chinese just cut a deal with the Taliban to pump oil. I don't remember how much it is. It's a modest sum. I would short it if that was a company and I could short it, I would, because that,
Sure.
the logistical issues are the other problem. So you look at a place like Afghanistan and you say, well, so the DoD wrote a report before I arrived there that said there's $1 trillion of minerals in the ground. Minerals in the ground is great. Very useful to know. I'm glad I know that. But of course, the difference between minerals in the ground and monetization is a sustainable mining firm.
Right.
And a sustainable mining firm needs to be able to export its product to market at a reasonable cost. Afghanistan is one of the few landlocked countries in the world, and we've got Iran on one side, we've got Pakistan on the other, we've got a mess of other stands to the north, and then actually technically you have Pakistan to the south also.
Not ideal. Not ideal.
Not ideal.
Getting raw material out.
Yeah, getting raw material out. There is a teeny itty bitty little corridor that you could take into China, but then you're dropping yourself off on the far western edge of China, and of course everything's on the eastern edge. Pakistan, it's getting over mountains. It's quite it's beautiful, but it's very mountainous. And then of course Iran, it's just not friendly to anyone. If Iran was a friendly country, things might change. I recognize that, and I would, I would love to go back to Afghanistan, and I hope that Massif Capital survives another 20 years, and I've got enough money that maybe by that point Iran will be friendly, and I can go back to Afghanistan and maybe try to help by building some mines or something. But until Iran is a friendly country, it's tough.
Sure. I'm gonna kind of go out of order in what I laid out to you for our conversation, because
doesn't matter. It's good.
It seems like what you invest in, it has a very cyclical nature. And like I was explaining to you a little bit, like at Sound Investing, we try to focus more on just very long-term things. So what I would, and correct me if I'm wrong, but what you're probably doing is not long-term buy and hold investing. So how do you, if that's wrong, correct me, but how do you time cycles for that? How do you time entries and exits into positions? How do you say and again, correct me if I'm wrong, but how do you say okay, the environment for energy or copper or nickel is good right now. We think prices are going to go up, so we want to invest in companies that mine those resources or drill for those resources, or say that those are bad and we want to maybe short companies that are in those resources. How do you time the cycles for these companies?
Yeah, so I think that so our average investment is sort of 3 to 5 years. So it's not short.
Yeah, that's not short. No, it's
but it's not necessarily, I would be, and we've had some investments go 7 years, 8 years. But you're right. They're not buy and hold. They're not compounders in the idea of sort of they all have high opportunities to reinvest capital at high rates of return. Sometimes they do if they have a new deposit or if it's a mine with a new deposit, but mostly they don't. So what I would say is, so the buy and hold mindset, okay, what you're trying to do, at least as I understand it and have deployed it, let's say in my personal account,
Sure.
is buy good things. Okay, right? I try to buy a company. I'm willing to pay a reasonable price. It doesn't need to be in the dirt because it's got reasonable compounding potential going forward. So I'm trying to buy good things. Okay, we try to buy things well. Okay, so what's the difference? The difference is, with your mindset, you immediately went to, okay, there's a cycle, and you are correct in noting that sort of because of that cycle, there's a window of time where these companies make a lot of money. And with that buy and hold mindset, you want to be invested at that time.
Sure.
But when we try to buy things well, there's a different mindset or a different approach. Okay. The question is not, are we going to buy and own this company when it is a good thing? It's more a question of the nature of the mispricing. So we could buy a bad company that was terribly mispriced. Now, that's not usually what we do, but that's sort of the focus is more on the mispricing and buying things at a good price. Right? And so what that means is that with oil, natural gas, mining firms, it's not about being invested such that you capture that period of time when they're making a bunch of profits because of the cycle, but rather capturing capital appreciation as a result of a catalyst that is company driven, that is separate from and different from the commodity cycle. So the example, the best example, the simplest example is a single asset mining firm. Okay, they have one asset. They've entered a period of building, okay, and they're building, and because they're building, and it's operational risk in some country, let's call it, I don't know, the Democratic Republic of Congo, everybody gets out. Okay, but what's actually happening? They're building an asset, they financed it, they permitted it, they're moving it towards production. And so as they take steps towards production, the risk that they don't turn on that asset actually decreases. And so there's a period of time where you enter and you buy it well, you buy it cheaply. And when they turn on the asset, if let's say it's a copper asset, let's say copper's running against them. Okay, so we bought it and it's trading at 0.3 of NAV. Copper's running against them. They turn on the mine catalyst. That NAV, it's going to go from trading at 0.3 to 0.8 of NAV. Okay, so it's just a good return. Now, if the copper is moving with us, it'll go to 1.2 of NAV. Okay, so we found that there are situations, basically, especially if you just focus on company level catalysts, that are sufficient to overwhelm commodity price impacts, that you can invest on the basis of companies. So rather than investing in the commodity cycle, we're investing in companies that are catalyst driven, that happen to produce commodities. If there's a commodity tailwind, it rises further and faster. If there isn't a commodity tailwind, it doesn't rise as much, but it'll still rise because the catalyst is sufficient to drive the stock price higher.
So what I find interesting is so I would have assumed going into this conversation, you would have looked at say, and I'm just picking any random, but copper, and say copper's low or the supply's tight, the demand's going to go up, whatever the case is. We think copper prices are going to go up this year. Let's buy a lot of companies that are in copper. And you're saying that's not what again, please correct me if I'm wrong, but that's not what you do. You're looking for specific company catalysts, for that copper mine in, and I don't even know where copper's mined, but in Congo, or in an emerging economy somewhere, probably, or wherever it is. You're looking for that copper mine and saying, okay, right now it's trading what we believe is it's very cheap for its long-term net asset value. let's get into it now. And as it starts producing, it'll, inflate to basically go back to its net asset value. And we're going to hold on to it for that period of time. So you're looking for like specific times in these specific companies, and you're not looking at like, say, the bigger copper prices this year are going to go up. So let's get into copper companies picture. Is that correct?
No, that's very much correct. Now, I mean, we're cognizant of commodity prices. We don't, look, we do invest in commodity producers. We can't ignore that in entirety. But what I think the big difference is, and this is not my phrase, I heard this somewhere and I don't remember where, so someone else deserves credit for this. But what you just described, in our opinion, is sort of an approach that we characterize as what often happens is timid bets on a bold forecast. So to your point, they say copper's going to 8. What should I do? Up 2% in Freeport-McMoRan, up 2% in Southern Copper Company, up 2% in Rio Tinto, etc. And so there, basically, what you're doing is you've made a macro commodity price forecast that you're then choosing to execute that idea via equities. Now, I think that part of investing well is not only having a good idea, but figuring out what is the best and most efficient way to execute that idea with, sort of the menagerie of financial products that are available. Now, if you think copper is going to 8 and you've done all this work on copper prices, it's not clear to me why you then go into equities. Why not go into futures and actually execute the idea directly? The idea is about copper prices. Why not execute it directly? Now, the opposite approach is how we think about our approach, which is a bold bet on a timid forecast. Okay, I don't know where copper's going. I haven't got any idea. My track record on commodity price prediction is I'm decent with the trend.
Okay.
Directionality. But like how high? No idea. Timeline? Directionality over a long term, pretty good. So we'd much rather buy a junior for whom turning on the mine doubles the price, regardless of what copper is doing, than that spread of copper bets and a bunch of copper majors.
So now, when you're figuring the net asset value of a mine, or you're looking at like the future cash flows that the mine might produce, how do you factor what the price of copper will be, I guess, in your projections? Like you just said, like, I don't know what the price of copper will be. So how does that, do you just come up with like a bear case, base case, bull case kind of scenario, or just figure we believe it'll be in this range? Or like, how do you, if you don't know what the price of copper will be, how do you figure that out?
We do, we're always told to think probabilistically, right? All of us are told to think probabilistically. And so we take that quite serious. And so what we do is, in the case of a mine, okay, we will lay out, lay out a DCF, a model. It's a project, right? So it's got CapEx, so we lay out a DCF. DCF for a mine is very easy to lay out. And then we will take, say, usually we do something like, what was the copper high over the last 2 years? What is the copper low over the last decade? And what's the average over the last decade? We'll run the DCF at each of those. Then we get our singular price produced from those DCFs. Now we've got 3 of them, let's say. One at that high over the last 2 years, one at the average, and one at the 10-year low or something. And we'll say, so we've got confidence in the trend that it's up. The supply situation looks bad, demand looks good. We'll put 50% probability on the base case, 25% on the high, and 25% on the low. Then we'll do a probability weighted sort of value. And so we've taken into account all 3 of those cases, and that's our target price. Now, over time, those probabilities may reweight themselves. as we own it. And as new information comes out, we may adjust those probabilities. But that's sort of how we approach it. We are making an effort at all times to bet on a spread of possible outcomes, as opposed to picking a singular commodity price and betting precisely on that.
That makes a lot of sense. So, and it makes a lot of sense too to look at a more granular level, like for these company specific catalysts, and say trying to predict what copper prices will be in a year, and then trying to make, as you described it, like timid bets on a bold prediction.
Yeah.
Let's shift to energy. In 2022, a lot of the stocks I was in did not do well. And when you look at the best performing stocks of the S&P 500 of the last year, it was dominated by like the legacy oil companies such as Occidental Petroleum, Hess, ExxonMobil, Marathon, Valero. Like, right, they just had a great year after a lot of years of down performance. Yet going into the year, like I think a lot of people, especially forward-looking investors, considered oil kind of like this dying sector. Not that it's going away tomorrow, but like, it's a slowing, dying sector because the world is shifting to green energy, and we're going to have electric vehicles and cleaner sources of power. So after energy's run up last year, like, I mean, are you interested in any oil stocks now? Are you, how do you think energy looks for 2023?
Yeah. So from my perspective, so first of all, I would divide energy, right?
Okay.
Let's talk oil first.
Okay.
Or let's focus on oil, because I think that's what you were sort of focusing on. I think oil is the most difficult commodity to think about the price going forward. It's
all right.
It's the one with like the most variables. I mean, they probably all technically have the same number of variables at play, but it's the one that seems like it's got the most variables at play. It's also the commodity with the largest paper market relative. I don't know if it's largest paper market relative to the size of the actual commodity traded market, but it definitely has the largest sort of just aggregate paper market. So financial activity tends to can move prices more in the oil market than it can in some other commodities, which might be one reason why we like metals more than oil and natural gas. But so back to your question. So I think if I remember correctly, and I'm probably slightly off on this, but I think actually 2021 and 2022, energy was obviously last year energy was the best performer. I think in 2021 it was also one of the top performers.
Yeah, I think that's probably right.
If you look at, say, some broad US indices. So 2 years in a row, just from a statistical perspective, without any sort of thought process around what we're actually talking about, 2 years in a row, and then a third year in a row of outperformance relative to the market is a statistically uncommon sort of event. Now, that's just a factoid to keep in mind. The details are what matter. From our perspective, I think oil is in a particularly tricky place. And the reason I think it's in a bit of a tricky place is on the long term, okay, the supply situation is quite bad. There's been a significant lack of investment as a result, in part, of what you noted, the sort of idea that it's an old and dead industry and dying industry. Okay. And so as a result, investors have come to them and said, look, we can put money in Twitter or Facebook and get this rip-roaring return. You guys need to give us something. And so the oil companies have mostly said, okay, well, we're going to return as much as possible to you and not invest. Okay, we're going to sweat our assets for cash flow and then return it all to you. So they haven't reinvested. Okay, so over some long-term period of time, the supply situation is quite dire. And it's quite dire regardless almost of what you think about a transition to a low carbon economy, because the speed of that transition, at least again, in our opinion, and we've written about this recently, is vastly overstated. This concept of 2050, or say, everyone you see a lot of we're not going to sell oil internal combustion engine cars in California after 2035, right? There are some serious sequencing issues here in terms of availability of resources, production of EVs, et cetera. Okay, this trend or this transition 2050 vastly overstated goal.
And let me just throw in a quick fact from one of your papers.
Yeah.
Like, I don't know if you personally authored it or your team, but it said fossil fuels currently supply 83% of the world's commercial energy. This compares to 86% in 2002, a minuscule decline of 3% in 20 plus years. So like even, even I was surprised by that. And I'm not a guy who thinks like oil is going away anytime soon, but I was still surprised that it just declined 3 percentage points in, almost 20 years.
Yeah. It's, look, the growth in renewables has been spectacular, right? It's been exponential. But it's a big globe. We use a lot of energy. Right. And so, and I'm a believer in the science behind climate change. But I do think that the science behind climate change doesn't tell us how to address climate change. It tells us technically how to do it, right? Technically, we can't release more carbon. That's very technical. That's where the science ends, though.
Right.
After that, it's a bit more of a discussion. It's a policy conversation. It's an economic conversation. How do we address this issue?
The devils are in the details.
Yeah, the devil's in the details for sure. The narrative and story that's been told about the transition, I think over, 20, where are we now? We're at 2022 to 2075, 2100. That seems reasonable to me.
Sure.
What people, I think where people struggle or where there's a bit of a blind spot for a lot of the narrative is this idea, okay, we're going to change the utilities. They're all going to be renewables. We're going to get rid of our internal combustion engine. And the problem is solved. Well, the reality is, and I gotta update my numbers here. They're going to be slightly off, but at best, absolute best, that addresses like 40% of emissions globally or something. That does not address. Now there's some bleed because utilities, power thing, but one of the largest sources of emissions is agriculture, is feeding ourselves, and that's an oil game, oil and natural gas game, right? It's oil to power tractors, it's natural gas for fertilizers, it's energy, food is just energy that's been turned into a form that we can eat to power ourselves. And so what's challenging with a lot of this is if I came to you and I said, we need to be carbon free, but our food is all produced by oil, your immediate we've got to get rid of the carbon emissions from the food, and we've got to get rid of the carbon emissions from the energy. Your response, or the logical response, would be, okay, well, first let's figure out how to get the carbon out of the food.
Sure.
And then we'll figure out how to get the carbon out of the utility system.
Right.
We've sort of reversed this one. We've said we're going to get rid of the carbon over here on the energy side. The food be damned.
Right.
And you're sort of like, okay, well, that's going to be a problem. I don't know where I was going with this, but there's this giant sequencing issue.
So let's continue on that note. Like, and I've heard you express your views on ESG before, but like, so ESG, like, and it's almost always like, or it seems like, from someone who doesn't look at ESG too much when I make my investments, it's like buy these asset-light businesses that don't have much of a carbon footprint, and now we can pat ourselves on the back and say we're investing in clean companies.
Yeah.
And I don't think you subscribe to that view, though, and that there might be a more, especially for the E in ESG, there might be a more holistic or more realistic approach to that. So why don't you just kind of explain like how you approach that?
So I think that it's look, if you're someone like BlackRock, okay, and you're not an active investor, you are a retail investor, you're looking for some place to put your capital, and you have concerns about the environment, how you service that audience, it is a challenge. Okay,
Sure. I mean, it's
someone like BlackRock,
right.
they've got
Trillions.
dollars. I don't know what they do. Okay, so the advent of the ESG ETF, I don't think we should fault anyone for that, and I don't think it's necessarily like, you get some people out there who just think this is like an egregious idea that borders on being in some way, shape, or form like evil or immoral, because we're going to deny the 2 billion people who live in Africa and Asia an opportunity to develop. I don't quite subscribe to that, but what I do subscribe to is the idea that ESG is not exactly what it's being marketed as. So if you buy an ESG fund, because you just don't want to be part of the problem, ESG probably somehow fits that bill, right? It's low carbon emissions. As you said, they just pick companies that have no emissions in the first place, right? If, on the other hand, you want to contribute your capital to companies that are solutions oriented and forward looking, you have to think differently. Okay, because you can't decarbonize an economy by simply regressing to just businesses that produce no carbon.
Sure.
Sort of already mentioned, there are businesses that produce critical economic goods, and those critical economic goods must be produced. And at the moment, the only way we know how to produce them is in a carbon, let's call it carbon medium to carbon heavy way. So we articulate a strategy that's based more on investing in solutions-oriented companies. And we think about them as either companies that enable a transition to a low-carbon economy, and they would be people like a copper miner. Okay, we need lots of copper for EVs, you need lots of copper for the grid, you need lots of copper for all kinds of different use cases. Okay, or Vestas wind turbines or Siemens Energy, they produce the equipment that facilitates a transition. Then there are companies that are transitioning firms. Okay, so steel, we still need steel, still need cement. Like everyone wants a house, everyone, we need to build buildings. Okay, so we need to come up with new ways of producing those goods. And so there are companies out there who have sat down. One of the most interesting parts about this is a lot of those businesses, right? Chemical businesses, steels, cement businesses, their business models haven't changed. Maybe there are some details, right? But the management teams are now sitting down, they're in hard science activities, engaged in research and development for new ways of producing their product that will create new business models. Okay, so those are the types of businesses we want to invest in. Now, at the moment, they have a heavy carbon footprint, but over time, that carbon footprint will go away as they invest and transition to new ways of doing things. Now, there are going to be some companies and some businesses where we just never figure out a new way of doing it, perhaps. Like there are probably some chemicals. Chemicals, of course, are the great example, right? All the chemicals we use are basically all
petroleum-based, right? Yeah.
Okay. There are probably some weird chemicals, maybe not even some weird chemicals. There might be widespread use chemicals that we just never figure out another way of doing. Those companies still need to be invested in, and there's still going to be profits to be made there. So has to take you have to take a balanced approach, and you've got not part of the issue and invest in an ESG fund and just sort of not contributing, if you will, or you want to be investing in companies that are solutions oriented. Now, I can't critique either approach. If you make a decision that that's what you want, but at least from my perspective, I'd rather be solutions oriented. I also think the opportunity set is bigger there.
So let's talk about maybe that opportunity set. We have a mutual friend, Bill Brewster, and he was talking about the Inflation Reduction Act, and I asked him to come on and talk about it. He goes, I mean, I can come on, but I'm just a guy talking about it. He goes, the guy you need to talk to is Will Thomson. And that's kind of what led me to reach out to you. So the Inflation Reduction Act, just so for viewers, because I didn't know this either, like it was signed into law last August, and it might have more in it about green energy than it does inflation, despite its name. It includes provisions for, I think, almost $400 billion in energy and climate related initiatives, maybe making it like one of the more significant environmental focused bills Congress has passed. But let's tackle this from like an investor's perspective. Like what can investors take away from this bill, and is there opportunities there?
So there are opportunities, but we've got to be sort of careful. Okay, so the bill, I would divide it into sort of two components. One would be various different support for energy, the energy system, if you will, that is, let's call it transformative, and another that is supportive. Okay, so the supportive side would be, tax credits for solar and wind. They existed, but now they've improved them and they've locked them up for a longer period of times. There's electric vehicle credits. There's residential clean energy related tax credits. There's some stuff for low emissions fuel, stuff like that. So it's a lot of extension of things that have already been in place, and some those say tax credits around the edges. Then there's what they hope, policymakers hope, are slightly more transformative parts about it, specifically things around, say, investment tax credits for battery storage, green hydrogen, energy efficiency solutions for commercial buildings, and carbon capture stuff. Okay, so there are these two big buckets, if you will. Now, I think that the transformative stuff, you're going to end up, if you want to find companies that are going to benefit from that component, you end up with earlier stage companies. This is especially true of stuff like green hydrogen, right? Green hydrogen, I think, has very few use cases, but it does have a couple of good ones. But the company businesses, the sort of industry, if you will, the value chain is very, very new, very young companies. The companies are going to be going to have high rates of growth, mostly because they're starting on a very small footprint. And the figuring out the key will be to figure out whether these companies are actually making money on a, say, a unit basis, or if they're not making any money and they're just collecting a government rent. I suspect that you're going to have a lot of both.
Sure.
That's just sort of the way it works out. On the other side, you have the supportive ones, or the supportive, the solar, the wind, the tax credits, things like that. Stuff that literally reduces the cost, basically, of installing solar and wind and things like that. You actually run, interestingly enough, into a very similar problem, which is it's very hard to tell whether a lot of these companies can actually make any money. And this is especially true in solar and wind equipment manufacturers. This is where we are. Solar and wind absolutely have a place in our energy system. Don't have is a role as the universal source of energy.
Sure.
So solar in Nevada makes sense. Solar in Maine does not. And so that's a challenge. Okay. But then all these equipment manufacturers that come before that question is even asked, with the price of electricity being driven down by solar and wind so much, the margin that's available to these equipment manufacturers is quite limited. And so what we find when we look at the value chains for the equipment manufacturers is that, in the case of, say, solar panels in China, we looked recently, and from the manufacturer of polysilicon to the end panel, there was basically like 4 cents available in margin. and I don't remember, I think it's not on a panel basis, it's on like a kilogram basis or something. I don't remember which, but we're not talking about a bunch of industries not sharing a lot of margin here. Of the 4 companies, you can sort of think about it as there being 4 companies in that stack. Of the 4 companies in that stack, only one of them made money. The rest of them lost money. And so that one company actually made 7 cents. And the rest of the companies lost money. How you come to the profit pool of 4 cents. Okay. So there's this question about whether at electricity prices where they currently stand, which in some regards determine the profit pool, whether these equipment manufacturers can even make money. Now, the IRA bill incentivizes bringing a lot of that production to the United States domestically. In China, and they did so on government subsidized coal power.
Right.
Bring it here to the United States. I'm not certain that you're even going to get that 4 cents. My
Sure.
guess,
You have a much higher labor cost and much higher maybe energy cost and everything else if you're not using government subsidized power. Yeah.
So I do think that what we're going to see a lot of is if a company trades on its revenue, say top line growth, and you're a trader, let's say, then there's opportunity because those companies will probably do well on, if they trade on revenue. But from an economic perspective, I don't think they're going to be making money. So if you want to buy as an investor and hold them for 3 to 5 years, as we like to do, with some sort of catalyst, and at the very least, we don't want a business that is just being run on government rents. I don't think there's going to be a lot of opportunities on the equipment side of things. Sure. Utility companies, utilities manage to deploy these assets profitably, but utilities have the return that they do, which sometimes can be good, but generally speaking, utilities are not punchy investments.
Right.
In the past 2 years, some of them have run quite far, but again, you do have to separate out the government tax credit, and I don't think they'd run as far as they have if you subtracted that out. The earnings are not as robust absent those credits.
And what about a company like Siemens Energy? Does a company like that have an opportunity here?
Yeah, so we do like Siemens Energy, and we do like businesses like Siemens Energy, which sort of cover the full energy value chain, if you will, from traditional generation to renewables and everything in between. Siemens is kind of like a one-stop shop. Let's say you run an electrical grid. You could come to Siemens and say, I've got a natural gas plant, I've got renewables, and I've got some space for solar, and I've got some space for wind. Build it for me. Siemens will build you the entire grid. They'll build the natural gas generator. They're the largest manufacturer of steam of turbines in the world, the second largest of natural gas turbines, the largest of steam turbines. Okay, so they'll build the turbine for you. They have a lock on a lot of grid technology. They don't make wires, but they make everything else that powers the grid, if you will, or that the grid runs on. They've got a bunch of hydrogen technology. They've brought in-house the entirety of Siemens Gamesa, so they do manufacture wind turbines. So there's this sort of one-stop shop that can address all your issues. And it happens to be in Europe, so it got smacked. And it happens to be a spin-off, and it was the stub that nobody wanted, so it got smacked there. So right now you've got, I would say, Siemens Energy, conventional generation, renewables, you've got demand growth for energy, decarbonization, digitization, decentralization, any of those big themes, they cover that. And it's, deeply discounted. I do think that Siemens, though, could be something you want to buy and hold longer term, right? That type of business can be viewed is not so much a project business, right? It's a going concern business.
Right.
So there is a potential for compounding over the long term.
So I don't want to, we're running up on time, and I don't want to keep you. So Well, I was again just looking through like the papers you have made publicly available on your website. There's a lot of them for people to check out. But one that caught my eye was Centaurus Metals. So this is an Australian listed mining exploration company, which is doing a nickel project in Brazil. And so this is the kind of thing I find fascinating because it's like, how do you even find something like this? So if you could maybe just like kind of one, how do you find something like this? And then two, like maybe just walk us through the investment case for Centaurus Metals real quick, because I think listeners will find it like as fascinating as I did.
Yeah, so Centaurus, how did we find it? I haven't got any idea how we found it. But in general, we find these sleepy, out of the way, well, not necessarily sleepy, but out of the way companies, mostly because, I mean, it's the universe we focus on, right? So look, our universe is, if you do it at the biggest level, it's like 5,000 companies with market caps greater than 200 million. Of that, I don't know, 1,000 of them or something are mining firms. And then we focus on a very specific sort of, mostly focus on a very specific segment of mining firms, which is to say mining firms that have a deposit that they are in the process of building. Okay, we don't, we're not geologists, so we don't invest in a company that, say, just has a geologist and is looking for a deposit. Okay, deposits got to be there. There's got to be technical docs that we can assess, operational docs, and we have to have an expectation that they're turning on the mine in, say, the next 5 years. Okay, so sort of make a cut that way. And the number of companies that are in that window, if you will, it's volatile, it changes every year, but you reduce the number of companies quite quickly, and then you can cycle through some pretty easily, looking at, say, the commodity price upon which they've articulated their investment case. And a lot of times what we see is companies that have articulated their investment case on a commodity price that is quite high, basically the way to put it. Okay. And maybe the commodity, whatever it has been there recently, but it isn't necessarily, it's like a 10-year high, right? So you're like, guys, what does your commodity case look like at the 10-year low or
Sure.
no?
Sure.
So we can get rid of a lot of companies that way. We follow a lot of companies in the mining space, and most of them are just not followed by anyone. So, but I think that, in the case of Centaurus Metals, they have, as you noted, what's called a nickel sulfide project in Brazil. And the nickel sulfide market is interesting because nickel sulfide there's two classes of nickel. There's class 1 nickel and class 2 nickel. Class 2 nickel you usually use in steel. Class 1 nickel is what they need for batteries. Okay, so if there's an argument to be made that EVs are going to grow and battery demand is going to grow, which seems to be the case, we need more nickel sulfide. And so Centaurus has one of the sort of highest grade, best nickel sulfide deposits in the world. And so that's sort of how we came to it, and part of what we think is so interesting about this project. They're a couple years away from production, so they sort of are in that orphan period where they're being ignored. Nobody's looking at them. They've got a decent management team that appears very capable of turning on this asset. With any of these project sort of focused companies, you've got to be laser focused on whether you think management is capable of executing the plan they say they're going to, because that's the bet you're making. It's not a nickel bet, it's a bet on their ability to execute. And we have sort of high conviction that they can do that. So.
Right. Will, where can listeners find out more about you and Massif Capital if they're interested?
So our website is massifcap.com. We produce a lot of research, mostly all of which is public, some of which we retain for our investors, but most of it is freely distributed. We got a mailing list. I'm on Twitter, although my participation goes sort of back and forth. Sometimes I'm active, sometimes I'm not. So, but those are a couple of places you can find us.
All right. Well, thank you so much for joining us today. I'm Matthew Cochran, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. If you enjoyed this podcast or if you watched it on YouTube, feel free to subscribe or leave us a review. Have a great day, everyone.